everyone, thank you for joining today's video. Today we're going to talk about more of the Soldivo Bond Fund. For those of you who don't know yet, it's the #1 intermediate term bond fund in the country. That's both for mutual funds and UITFs. It has given already 5.7% as of the end of April. So we're happy and we're lucky to have with us the fund manager himself of the Soldivo Bond Fund. His name is Mr. Miguel Riboro, and he has already earned many accolades. One of the most impressive of them is being the most astute fixed income fund manager in the Philippines. He has been ranked by the Asset Magazine as #1 from 2015 to 2019. So please welcome Mr. Miguel Riboro. Hello, Miguel. Hi.
Thanks again for that very flattering intro, Jerome. So what do we do here with the Soldivo Bond Fund? Well, we took over the management of the fund in February last year. And as you pointed out, we've had an okay year, even amid the market volatility and especially very poor equity markets, both locally and globally. The fund has generated a net of all fees, taxes, return of around 5.7 to 5.8% as of the end of April. Since we took over the fund last February, in aggregate, I think, as you can see on the slide over here, we've generated 11.8% worth of net returns. Now, it's very difficult to kind of generate consistent returns across varying economic backdrops and different conditions. But we try to do that by really focusing on three things. So the first is managing the risk. We always want to try to make the most we can for our clients, but this means analyzing the risks and taking only the risks that we think are worth taking in order to generate those optimized returns. Because sometimes you're right, but you can't be right all the time. And you need to manage the risk that comes along with making these investments. So what we're trying to do is not just maximize the return for our clients, but give them the optimal risk-adjusted return. And what does that mean? That means, as you can see in point 3 there, ensuring that we generate the most return for our clients or the portfolio by generating the least amount of risk possible. And I think you can see that in the number in the box over there, the return to risk ratio. What that essentially says is you were able to generate quite a substantial return relative to the amount of risk we were taking. Because the higher that number is, the better the risk-adjusted return was. So I would say that that one would be quite decent for fixed income as an asset class, and anything above one would actually be quite good. And we've been able to deliver very decent risk-adjusted returns of 2.65. More than just being cautious all the time, it's more of, as I mentioned earlier, being able to detect based on the views in the market and the changing conditions, whether or not it's an environment that warrants taking more risk or less risk. And as you said, we've been able to do that quite well over the last year and a half, and it's showing in the returns.
All right. So I think for my next question is those who are already invested in the Soldivo Bond Fund. So what should I be worried about? Or I mean, what should I be thinking about right now? Do I need to invest more? What can I do so that I could take advantage of these gains?
Actually, without getting too technical, if you look at the slide in front of you right now, what that shows is how the portfolio was positioned as evidenced by the blue line and where yields were on as recently as mid-April by the green line. Now, what you can see is over the 2-week period, yields moved down significantly, moving down to where they are on the yellow line over there. And as a result, the positions in the portfolio, which were really more focused on longer tenor securities at the time, generated greater capital gains or price appreciation. So given what happened in our view on the market, what we did for the fund was we took profit for our investors. We locked in those gains, and now we've moved to a more defensive positioning. Because what we think is, after that rather significant rally over that 2-week period, there could be room for rates to move higher and erode some of those gains. And that's why we took some of the chips off the table. That's why we locked in some of the gains for our investors And I think you can continue to add into the portfolio, into the fund, because you know that we're not just taking risks and taking risks. We're also very cognizant of the risks involved. And so very prudently, when we think that it's time, we also take profits.
What you've done is you've already protected the gains that the fund has and redeployed it to other securities that you think will give the fund more gains.
So as I mentioned earlier, one of the things we always look at is how to give the best risk-adjusted return. So as you can see from the graph over there, where yields are now are quite low. For example, a 1-year bond will give you a 3% interest rate, and a 10-year bond will give you a 3.3% or 3.2% interest rate. For us, that's not a very big difference at all. So given that, and given the fact that we don't think that the 10-year will go any lower for now, we would rather move into a safer security like the 1-year or 2-year, as you can see in the graph there. And in that way, protect the investment.